Welcome to the Explainer. Today, we are cracking open what might be the single most important book on finance ever written, Benjamin Graham's masterpiece, The Intelligent Investor. So let's get right into it, because what Graham gives us is a timeless strategy, a sort of mental toolkit for navigating the absolute chaos of the financial markets and hopefully surviving with both your money and your sanity intact. And to see just why we need this toolkit, let's start with, well, one of the smartest humans who ever lived, Sir Isaac Newton. This is the guy who discovered the laws of gravity, but get this, he couldn't escape the gravity of a market crash. He lost an absolute fortune. We're talking millions in today's money, in a stock bubble. So you gotta ask, if a genius like Newton can get completely wiped out, what hope is there for the rest of us? Well, according to Graham, Newton's big mistake was that he wasn't playing the right game. See, he started out playing one game, investing, but he got sucked into playing another, gambling. And this, right here, is a mistake that countless people, brilliant or not, make every single day on Wall Street. Graham drew a line in the sand, and it's crystal clear. He said an investment has to meet 3 tough criteria. 1, it's based on deep analysis. 2, it promises that your initial money, your principal, will be safe. And 3, it aims for a satisfactory return, not a crazy shoot-the-moon one. If what you're doing fails even one of those tests, it's not investing, it's speculation. It's gambling, plain and simple. You know, the temptation to speculate is so powerful. It's that little voice that says, hey, this time it's different. But Graham warns us with a really harsh truth. People who speculate are mostly just making money for their brokers. It's the people who actually invest who end up making money for themselves. So why is it so darn easy to get pulled from the safety of investing into the thrill of speculating? Well, to explain the psychology here, Graham came up with an absolutely brilliant metaphor. A business partner he called Mr. Market. Okay, I want you to picture this. Imagine you own a piece of a business and you have this partner, Mr. Market. And he's a little unstable. He's basically a manic depressive. And every single day, without fail, he shows up at your door. Every day, he offers to either buy you out or sell you his share of the business. Now, some days, Mr. Market is just euphoric, totally giddy, and he'll offer you some ridiculously high price for your shares. But on other days, he is completely terrified, just despondent, and he'll offer to sell you his shares for pennies on the dollar. But here's the most important part. He doesn't care if you ignore him. He's there to serve you, not to guide you. You are totally free to just shut the door, and you must never, ever let his mood swings control your decisions. The whole secret is right there. You have to treat Mr. Market's emotional problems as your business opportunity. You use his wild mood swings to your advantage, as long as you don't catch his craziness yourself. And this idea leads us right into Graham's most powerful concept for protecting yourself from Mr. Market, and honestly, from yourself. So, how do you really shield yourself from all this madness? And, maybe more importantly, from your own mistakes? Graham's answer is his single most famous idea. It's the absolute foundation of his philosophy, the margin of safety. The idea is just beautifully simple. Never overpay. That's it. It doesn't matter how great an investment looks, you have to have the discipline to always buy it for way less than you think it's actually worth. That gap, that difference between the real value and the price you pay, that's your margin of safety. So let's say you do your homework and figure out a stock is really worth about $1. An intelligent investor doesn't buy it at 99 cents. No way. You wait. You wait for Mr. Market to have a bad day and offer it to you for, say, 60 cents. That 40-cent gap, that is your margin of safety. It's your cushion against bad luck, errors in your own judgment, you name it. And having that cushion is absolutely critical, because the math of losing money is just brutal. If you lose 50% of your portfolio, you don't need a 50% gain to get back to where you started. No, you need 100% gain. You have to double your money just to break even. That's why avoiding the big losses is the real secret to long-term success. And the margin of safety, that's your best defense. Okay, so this all sounds great in theory, but how do we actually do it? Well, Graham wasn't just a philosopher. He laid out some very clear, simple rules for what he called the defensive investor. That's someone who wants good results but isn't trying to make a full-time job out of it. He basically gave us a 4-point checklist. First, spread your risk. Own between 10 and 30 different stocks. Second, stick to quality. We're talking large, well-known companies that aren't drowning in debt. Third, demand consistency. Look for companies with a long, unbroken history of paying out dividends. And finally, the rule that keeps you honest: don't overpay. He put a hard limit on it. Never pay more than about 15 times the company's average earnings. See? This bakes that all-important margin of safety right into your process. When you boil it all down, Grimm's philosophy isn't really about picking hot stocks or using complex formulas. It's a behavioral framework. It's about discipline, about protecting yourself from the market's craziness, sure, but mostly from your own worst impulses. And it all leads to this one powerful idea. The biggest risk to your money isn't a bad market or a recession. The biggest risk is staring right back at you in the mirror. So the real question is, what kind of investor will you choose to be?